Thinking about the May reporting season, it's a relatively small one compared to what we see in February and August. There's a handful of listed property companies and only a few of the large companies reporting results. If we look at share price performance over the month, Mainfreight was a real standout. Its share price was up more than 26%. Leading into that, Mainfreight had been pretty weak as investors weighed the impacts of tariffs and a potential slowing global economy on its business. It reported as a result. In fact, it provided a trading update early in May, which said that their result would be ahead of market expectations, and they delivered that later in the month. It was a bit of a mixed bag across the regions. Australia was very strong, some weakness in other areas, but overall a good result, and that was reflected in the share price performance over the month. Infratil was another interesting one. Earlier in the month it had some updates with investors, sort of alleviating some of the concerns around data centre demand. So on the back of that, the share price was up around 10% ahead of its result. Its result was actually towards the upper end of its previous guidance. Where they did disappoint though was on its forward guidance, so for the next financial year, around the data centre business in particular. So while they're still expecting data centre earnings to double over the next 2 years, it's not linear, and so more of it will come through in financial year 27 rather than 26. And so that 26 earnings guidance from Infratil was weaker than the market expected. It ended up with the share price flat over the month after being up 10% earlier. While not a particular standout, having half a dozen property vehicles report results was interesting. They've been through a long period with high interest rates impacting their portfolio values. So the property values over the last few years have been declining. On the back of falling rates now, we're starting to see a steadying of those property values. In fact, in some cases, starting to see some property value increases, which is pleasing. Ryman was a stock of huge interest going into reporting season. They surprised the market in February with a large $1 billion capital raise and a trading update, which was somewhat disappointing to the market, and share price had been weak on the back of that. So going into this result, investors were really interested in what they were saying about the forward outlook, rather than its result itself. The result versus the metrics that it provided at its capital raise delivered on those, and in some cases beat. Where it did miss though was around its asset backing, so they had more write-downs than was expected, and it's seen its net tangible assets fall back more than the market was expecting. And looking forward, their sales expectations for the year ahead are slightly less than what the market was expecting. That said, we're 6 to 8 weeks into the new financial year. It's early days, so there's a potential there for them being conservative. They've got a new executive team, they've got a new board. I don't think they want to put out numbers that they can't meet. On Fisher & Paykel Healthcare, look, it was a good result. It was slightly ahead of their previous guidance. And in fact, it was a record year in terms of revenue. So the first time they've delivered more than $2 billion of revenue. Also, margin delivery was slightly better than expected as well. So going well there. Slightly disappointing in terms of their forward guidance versus what the market was expecting, while still thinking that they're going to grow more than 10% or around 10%. That was slightly less than what the market was expecting. Again, early in the new financial year, a lot to go under the bridge in terms of that. So potentially more conservatism in their guidance as well, and time will tell. Given it was a small reporting season, as I say, with only a few of the large companies reporting, there's not a huge amount to take out in terms of a view on the economy. What we did see though were a couple of updates. So Sky City, it was an earnings downgrade, so not part of a result, but just an earnings downgrade. Just still highlighting the weak economy. And also Fletcher Building provided a trading update in one of its releases, saying that things are still very tough out there, not seeing any noticeable improvement in their business and the economy. In terms of our portfolio, we've been increasing exposure to interest rate sensitive names such as real estate, continuing on with defensive earnings and also structural growth stocks. Being active managers, we're continually making portfolio changes, continually assessing new information, looking at share prices. On the back of reporting season, we haven't made any large material changes to the portfolio. Looking forward, realistically, thinking about the next reporting season, so sort of 3 months ahead, we'll get another update from corporates, more about what they're thinking about forward-looking rather than the result itself. The result, we understand the economy that we're operating in right now. It's what they're starting to see in 3 months. That will provide us a better feel for how the economy is going, how companies are going. We know a recovery will come. It's just trying to figure out the timing of that recovery. One of the key things I think about with regard to falling rates is the economic recovery. That will come towards the back end of this calendar year, potentially the start of the next calendar year, so into 2026. And then on the back of that, we'll start to see corporate earnings. So as companies report their results, we'll get an update as to how they've been trading, and more importantly, is what they're seeing looking forward. Then one of the big things that will drive the market and valuations is what we're seeing in fixed income securities and specifically term deposits. Term deposits peaked at around 6%. They're now sub 4%, probably going lower, potentially towards 3% as the Reserve Bank continues to cut interest rates. There's about $160 billion sitting in term deposits. And when those term deposit holders start to see those roll over and going from 6% to 3%, they'll start to look to alternatives. Where else can they invest their money to get a similar yield or a similar cash flow to what they've been receiving previously? And some of that money will flow into equity markets and the New Zealand market. And we don't need to see much of that $160 billion move to have a somewhat material impact on the equity market.